A Mutual Fund Guide. Chapter 1. Mutual Funds Guide. Mutual Funds Info. A mutual fund is a company that brings together money from many people and invests it in a bunch of stocks, bonds, or other securities, and together, this group of particular investments make up one distinct mutual fund with its own name, much like a stock has a name. Mutual funds are a bunch of stocks and other investments picked by the so-called experts/managers in an investment company, all put together into a fund, which is generally a much safer investment than a stock because the investment isn't on just one company or stock. Rather, it's spread out over a bunch of companies so that if some of them aren't doing so hot or fail, the losses will probably be compensated for and then some by the companies that are doing better. But on the other hand, the gains will not be as dramatic as a good stock. The combined holdings of stocks, bonds, or other securities and assets the fund owns are known as its portfolio. Each investor owns shares, which represent a part of these holdings. All mutual funds will redeem, buy back, your shares on any business day and must send you the payment within 7 days. You can find out the value of your shares in the financial pages of major newspapers. After the fund's name, look for the column marked NAV. Each fund's portfolio might contain anywhere from 50 to 500 stocks or different investments. Mutual funds are not guaranteed or insured by any bank or government agency. Even if you buy through a bank and the fund carries the bank's name, there is no guarantee. You can lose money. Mutual funds always carry investment risk. Beware of dazzling performance claims. Many ads are deceptive. Don't make a decision based on an ad alone. A mutual fund might have one manager or several, each focusing on one aspect of the fund, like growth stocks, income stocks, etc. Within the mutual fund arena, there are several major companies called families which offer a large variety of mutual funds like Fidelity, T. Rowe Price, Vanguard, Charles Schwab, and Price Waterhouse. You can easily switch from one fund to another within the families, and some have discount brokerage services where you can buy mutual funds from other companies through them. So, for simplicity's sake, you get your quarterly statement all on one sheet, which is much easier than if you own several funds from different companies. Being a shareholder with Fidelity and Vanguard, I get regular magazines from them about their investments. Call them and ask for these free magazines. People like mutual funds because they're generally more safe than stocks because they're diversified, they're professionally managed, taking the headwork out for the investor, they're peaceful, convenient and liquid. They're very simple investment instruments. The only hard part comes when you analyze what stocks or bonds comprise the fund you're investing in. You could play it safe and pick bond funds or pick from the wide variety of stock funds out there. The growth/aggressive funds can be risky, with the safest road being to pick mainstream type balanced and index funds which replicate the major stock indexes like the Dow Jones and Standard & Poor's, simply picking all their stocks from them. Try for a fund with greater than $100 million in assets, because anything less will translate into you paying the fund manager high fees in order to make it worth his while. Anything more than $1 billion is too big. Any changes will probably be too small for you to register much of a gain. Beware of all charges with the fund, like the 12-1B, transaction fees, front load and back end load, and expense fees. These are 4 places they can take money from you, hidden in the small print of prospectuses, and is one of the reasons I don't particularly like mutual funds. Your best bet is always the broad mainstream index or balanced fund. Look at the companies in the fund. Hot funds that have made the cover of Money magazine will suffer the bandwagon effect and invariably cool off. Knowledge is only good to a certain point, there's always an element of luck involved. Of all the mutual fund investment newsletters out there, I like the Morningstar Forecaster because it gives you a graphic view as well as a good verbal report on the fund. You can buy some mutual funds by contacting the companies that manage them directly. Others are sold mainly through brokers, banks, financial planners, or insurance agents. If you buy through these financial professionals, you generally will pay an extra sales charge. You can find the value of your shares by looking in a business newspaper and checking for the fund's NAV, net asset value, per share. A fund's NAV fluctuates daily in response to changes in the market. The NAV, net asset value per share, is the value of one share in a fund. When you buy shares, you pay the current NAV per share, plus any sales charge also called a sales load. When you sell your shares, the fund will pay you NAV less any other sales load. A fund's NAV goes up or down daily as its holdings change in value. 3 ways to make money from mutual funds. First, a fund may receive income in the form of dividends and interest on the securities it owns. A fund will pay its shareholders nearly all of the income it has earned in the form of dividends. Second, the price of the securities a fund owns may increase, which is the growth of stock price. When a fund sells a security that has increased in price, the fund has a capital gain. At the end of the year, most funds distribute these capital gains, minus any capital losses, to investors. Third, if a fund does not sell but holds on to securities that have increased in price, the value of its shares, NAV, increases. The higher NAV reflects the higher value of your investment. If you sell your shares, you make a profit. This also is a capital gain. Usually, you have a choice whether to receive a payment for distributions and dividends or to reinvest your gains back into the fund. Be careful of a fund group that charges a fee for reinvesting your dividends back into the fund. You owe taxes on all gains and profits. You will owe taxes on any distributions and dividends in the year you receive them, or reinvest them. You will also owe taxes on any capital gains you receive when you sell your shares. Keep your account statements in order to figure out your taxes at the end of the year. If you invest in a tax-exempt fund, such as a municipal bond fund, some or all of your dividends will be exempt from federal, and sometimes state and local, income tax. You will, however, owe taxes on any capital gains. Yield is defined as total dividends divided by current value of a share over a certain time period. A more useful indicator is total annual return. Net investment income, or loss, is what the fund is earning in dividends and interest after expenses. Net asset value /NAV is simply the value of one share. High expenses could turn a potentially good invest into a mediocre one. A good idea is to set up an account with a multi-fund brokerage firm so that you can do your research on their many funds and transfer your assets around them with little hassle. They want you to keep the money in one fund for a while though, so if you make over a certain amount of transactions per year, they will start charging for them. Check the fund's tables to see if there's an exchange fee. A mutual fund stock split or dividend payout may affect the number of shares you own, but it won't affect the value of your investment. Banks sell mutual funds, some of which carry the bank's name, but mutual funds sold in banks, including money market funds, are not bank deposits. Don't confuse a money market fund with a money market deposit account. The names are similar but they are completely different. A money market fund is a type of mutual fund. It is not guaranteed and comes with a prospectus. A money market deposit account is a bank account. It is guaranteed and comes with a truth in savings form. The banks take a quiet commission on money market funds which they rarely tell the customer about unless pressed about it. Investing in international mutual funds may be a good step towards diversification, since foreign markets may be out of sync with American markets, so that when one is down, the other may be up. Before buying a fund, check out the redemption procedures when you want to liquidate. Many companies require a special form or letter to be filled out and your signature verified in some way. Also ask if you can make transactions over the phone without paperwork. Many funds allow you to exchange your shares for shares of another fund managed by the same company. The first part of the fee table in the prospectus will tell you if there is any exchange fee. Don't buy a fund less than 3 years old. Big funds can perform as well as small funds. Watch the capital gains tax trap. Keep a balance of different types of funds. Fund fees and other negative things about funds. The bottom line right up front is that all mutual funds charge fees, at the very least annual management fees. If they're too high or get too high, move on to another fund. There is no qualitative difference between load, upfront fee/commission for buying fund, versus a no-load fund, so unless you really want a load fund, always buy no loads and check to see that the management fees aren't too high. A mutual fund fee table breaks costs into two main categories: sales loads and transaction fees, paid when you buy, sell, or exchange your shares, and ongoing expenses, paid while you remain invested in the fund. The first part of the fee table will tell you if the fund charges any sales loads. No-load funds do not charge sales loads. When you buy no-load funds, you make your own choices, without the assistance of a financial professional. There are no-load funds in every major fund category. Even no-load funds have ongoing expenses such as management fees. When a mutual fund charges a sales load, it usually pays for commissions to people who sell the fund's shares to you, as well as other marketing costs. Sales loads theoretically buy you a broker's services and advice, they do not assure superior performance. In fact, funds that charge sales loads have not performed better on average, ignoring the loads, than those that do not charge sales loads. There is no evidence to suggest any differences between load and no-load funds. There are over 20,000 different mutual funds out there, getting bigger all the time. The second part of the fee table tells you the kinds of ongoing expenses you will pay while you remain invested in the fund. The table shows expenses as a percentage of the fund's assets, generally for the most recent fiscal year. Here, the table will tell you the management fee, which pays for managing the fund's portfolio, along with any other fees and expenses. Even if the fund is losing money, the managers will still take their cut. A no-load mutual fund is one where you can open an account and enter into it for free without paying any upfront fees. The fund calculates a growth rate in some interval of time and you earn money based on the percentage of growth. The way you pay the fund managers is through a management fee called an expense ratio, which usually goes around 1 to 2%. Look for it on the prospectuses. If it's higher than 2%, it's too high. I've seen them as high as 4%. Another unreasonable fee they may take out is what is called a 12b-1 for marketing and distribution. It most often is used to pay commissions to brokers and other salespersons, and occasionally to pay for advertising and other costs of promoting the fund to investors. If it's over 0.5%, it's too high. Call the 800 number and ask what their fee is for 12b-1. A front-end load is a sales charge you pay when you buy shares. This type of load, which by law cannot be higher than 8.5% of your investment, reduces the amount of your investment in the fund. A back-end load, also called a deferred load, is a sales charge you pay when you sell your shares. It usually starts out at 5% or 6% for the first year and gets smaller each year after that until it reaches zero, say, in year 6 or 7 of your investment. Funds with back-end loads usually have higher 12b-1 fees. If you are considering whether to pay a front-end load or a back-end load, think about how long you plan to stay in a fund. If you plan to stay in for 6 years or more, a front-end load may cost less than a back-end load. Even if your back-end load has fallen to zero, over time you could pay more in Rule 12b-1 fees than if you paid a front-end load. Most funds are an outright risk as an investment. Some funds are protected by the Securities Investor Protection Corporation, but that's only if the brokerage goes out of business. It's not related to the value of the fund at all. Unless your money is in a tax-deferred retirement fund such as a 401k, or an IRA, you will probably have to pay taxes on your fund's gains when it sells stock within the fund. You may even have to pay taxes when your fund loses money. It's too complex for me, but I've seen it demonstrated. There is a concept called soft money where fund managers legally get a kickback when buying stocks from full brokers as opposed to discount brokers. This is a shady side that's still allowed. It could encourage churning by the manager, buy and sell more stock to get this kickback. It appears that actively managed funds don't do as well as the passively managed index ones that simply buy what's in a particular stock index. There is some element of luck in managing a mutual fund. The fund manager's job is to attract new money, so they often have great ads touting their past performance, but if you watch carefully, past performance often doesn't indicate future performance. Most top-performing funds in any year are not the top-performing ones in the next year. Most managers are really gambling day traders in their mentality, always trading stocks within their funds, which drives costs up. Fund managers pick fund names to appease the buying public, but often these names don't reflect what's really in the fund. Do your own research. See what stocks a particular fund currently has in it before you buy it. It's all there in the public disclosure on the website if you are willing to take the time to look. Don't buy funds from an intermediary like a brokerage. They tack a sales fee onto it. Buy a fund directly from the company that owns it. Look for funds with no load fees, no 12b1 fees, and an expense ratio of less than 1%. Closed-ended funds. Most mutual funds are open-ended, meaning that they allow people to come in and invest at will, hence, there's no limit to the number of shares or people who want to get in on it. They just keep investing what comes in. In times of crisis, most stockholders will sell low, thereby forcing the mutual fund to lose value. Closed-ended mutual funds are the most secure since they have built-in controls to protect from that. A closed-ended fund is like a stock with a set number of shares that can be issued and sold and resold on the market, and the issuers only raise money with the initial offerings. There are usually commissions charged on closed-ended funds. The Wall Street Journal Monday paper and Barron's list closed-ended funds and the prices they're selling for. While the value of an open-ended fund is generally dependent on the value of a fund's holdings alone, the value of a closed-ended fund depends on both the fund's holdings and the supply and demand for them in the marketplace. How to pick a fund. The way I pick funds is to get the book of annual reports/summaries that a company which has a family of 20 or more funds publishes every year for its investors. These are the big mutual funds companies like Vanguard, T. Rowe Price, Fidelity, or Charles Schwab. In this book, on one page, they usually have a bar graph which lists all their funds and shows the percentage change over the past year in chronological order from the highest increase to the highest loss. This is as simple as it gets, and you can gain valuable insight into different sectors of the economy simply by looking these bar graphs over to see what's hot and what's not. I use these graphs as my research to pick stocks because funds are simply diversified stock portfolios in different sectors, and you can gauge how a sector's doing by checking out mutual funds in that sector. When I saw biotechnology make marginal gains in several fund families, I cashed in my biotech stocks and put my money to better use. Another way to pick funds is simply to go to a magazine like Kiplinger's, Forbes, Money, etc., pick up the last year's stack of them at the library and go through until you find an issue dealing with mutual funds. Then go to its list of highest yielding mutual funds for the past month, call the toll-free numbers, get their prospectuses and pick what you want. Many people buy mutual funds based on past performance, but the problem is the bandwagon effect, as already discussed. Just like stocks go in trends, so do mutual funds. What's hot now could be a dud next month. Your best education, in my opinion, is to learn about the portfolio manager's experience and track record from the prospectus. Then you will know if a stable guy or gal is managing it. You'll be able to separate the new fluke from the time-tested veteran who's been successful for the past 10 years or so. Look at the expenses involved. When comparing funds, don't necessarily compare across the board, compare the fund to others in that particular field like high-tech or aggressive. Beyond the track record of the manager, look for that special fund that has a unique niche in the marketplace. Brand name is very big. For example, Magellan is a very popular huge fund that people invest in because they know about. There is a debate over whether big mutual funds with several billions of dollars of assets are better than smaller ones. Usually the bigger ones have been hot and are now fading, plus the fact that a positive change in the fund will have a smaller effect on your cut of the pie than with smaller funds. Conversely, if a small fund loses, you lose bigger. The deal with big funds is that as people pour money in, the manager is running out of good stocks to invest in, so they invariably go down. It's very easy to buy mutual funds. Simply go to one of the investment magazines like Money, Forbes, or Kiplinger's, call the toll-free numbers or go to the websites of some of the funds listed, get their prospectuses, read them over, decide on which ones you want and send a check in. Your best bet is to go to the magazine stacks at the library, look through the above-mentioned magazines until you find an issue which lists anywhere from 500 to 3,000 funds. Simply go down the list, pick out the ones with the highest percentage returns, get their prospectuses and proceed from there. The prospectuses are the reports the funds put out about themselves. They may be complicated and boring, but the smartest thing you can do is to study them and learn about them before you invest. Beyond that, you could also ask for a copy of the annual report and a free copy of the Statement of Additional Information, SI, to really dig into the inner workings of the fund. If you request a SI, they must send it you. Don't be shy about calling the customer service representatives and asking questions. Check a fund's total return, which measures increases and decreases in the value of your investment over time, subtracting costs. See how it has varied over the years. Look at year-to-year changes to see how stable it is. The key to making money with mutual funds is to buy a diversified growth stock fund that is in the top 15% of all such funds for the past few years, then sit on it for the rest of your life. Let the principle of compounding work for you. Compare the fund's performance with other funds in the same industry and with the performance of funds in the entire mutual funds industry. Just like a stock, mutual funds have betas, and there are reports out there that compare the volatility of mutual funds. The wider a fund swings up and down, the more risky it is. Beyond total returns, two other factors which come into the formula. Turnover rate. Funds with a high turnover rate, meaning lots of buying and selling of the stocks in them, probably means frequent capital gains, hence, taxes on them could affect overall results. You can call the fund's account number and ask for this information. Tax efficiency rating. The other indicator, the tax efficiency rating, gives the fund's overall return after taxes. A rating of 80% or better is really good. Take this into account when considering mutual funds. Check to see what special privileges funds offer, like liquidity, switching funds, etc. If you plan to be an active trader, you can get a margin account where you get a line of credit from your broker at a certain rate of interest that you can use to invest in other mutual funds. Brokers may give advice about load funds, but they're getting the commission and pushing their own company's product. Send for the prospectuses, read some investment magazines, etc. And make your own decisions, but beware of the prospectuses. Although they legally have to show accurate information about past performance, most companies hype them up, some lie, and some are downright junk funds with some good companies in there for show and the rest all phony companies. Just be careful. Stick with the big companies over the ones that own just one or two mutual funds. If they haven't been in business for a while, they could be frauds. Don't make a habit of jumping in and out of funds. Stick with a few that you have researched well. New funds don't have a track record, so watch it. Keep up on your investments. Check on them every few months. Some funds have a transaction fee for transferring funds within a fund company. Remember that most funds create tax bills. Monitoring a mutual fund. After you buy a fund, you can either look it over on the internet periodically or look up the mutual fund tables in newspapers like the Investor's Business Daily, Wall Street Journal, USA Today, or the New York Times, and look at the current NAV, net asset value, which is the price you would receive if you sold one share of your fund. Refer to the following table of how to read a mutual fund. Name of fund, investment, NAV, offer, NAV. Objective price change. JD Growth SML 7.808.30 plus 0.15. YTD 14R. Years. Plus 10.4 plus 9.8 plus 15.2 C. The investment objective category has several classifications. Seconds, sector funds which focus on one area. BHI, bond high yield funds sometimes called junk bonds. BND, intermediate and long-term bond funds. BST, bond short-term. MUN, municipal bonds. SML, small company growth funds. STK, general American stock funds. WBD, world bond funds. WAR, world stock funds. The NAV, the net asset value per share, is the price you would get if you sold your shares on that particular day. Offer price is the price including commissions and loads that the fund is selling for. If it's a no-load fund, they will list it as NL. NAV change shows the change since the last day of trading. YTD is the total return year-to-date gain or loss in values so far this year. 1 year and 4 years are the gain or losses in the fund's value over those time periods. The Wall Street Journal ranks funds in the R category for performance on that day from A to E, with each letter going down 20% in a hierarchy of performance. Systematic withdrawal from an MF. You can get an option with your mutual fund company whereby every month, they sell X number of shares of your mutual fund or funds to reach the monetary value you want sold and deposit the cash into your money market account with them. Major difference between stocks and funds. A good stock is a good company. It goes on a run, has its heyday and stabilizes. That's when you sell it. A good mutual fund is a network of a bunch of stocks which are constantly being changed by the managers. It's much more susceptible to the forces of the market as a whole than are good stocks. When the stock market burns as a whole, every mutual fund drops, but if you have a few good stocks, they could keep going despite the bear. Although I started out as an investor by investing in funds, I have since learned that you're better off finding a few good stocks and sticking with them. You pay out too much in fees on funds anyway, and the gains are generally paltry next to a good stock. Plus, when the stock market burns as a whole, all mutual funds lose while there are good stocks that always keep gaining. When the market recovers, the big stocks usually bounce back to old levels, but a bunch of little stocks get left behind, stuck with their losses. That's the way it works, so your mutual funds will not parallel the recovery in the Dow Jones Industrials. Find a few great stocks and stick with them and bypass funds altogether, or start out in funds then move into stocks. I started out thinking I was safe in funds because they're diversified, but the thing is, if you find the 5 greatest stocks out there, which really isn't that hard because there are plenty of top performing lists out there, chances are that you will make a hell of a lot more money than you will if your money is in a fund. Funds are really not as safe as doing your homework, finding a few good stocks and going with them. If the market is going down, you might consider transferring your no-load funds to a money market fund within the same company. Granted, all investments are risks. Many oodles of people play it safe by putting their money into mutual funds because they think that if a few of the stocks in the fund fail, it will be offset by the diversity. Granted, a great stock could fail at any time, and if you invested in it, you'd lose big. If you want great gains, you got to assume this risk by investing in stocks as opposed to funds, the risk of possibly losing all. If the market drops, all mutual funds will drop, which is why I don't like them, but good companies stay strong, so that's where I stay. Mutual funds are wimp investments next to stocks. Chapter 2. Types of mutual funds. 1. Types of funds. There are many types of funds, the risks dependent on the types of securities they invest in. The general hierarchy in risk in funds from the lowest to the highest are: money market funds, mortgage funds, fixed income funds, bond funds, balanced funds, dividend funds, equity funds, real estate funds, international funds, sector funds, focusing on aspect of the market like energy, leisure, utilities, financial services, etc. From the lowest to the highest risk, here is a list of some of the more basic categories. Bond funds are the most common low-risk funds which invest in all kinds of bonds and government securities. There are many different types, some of which are corporate bond funds which purchase bonds of U.S. corporations. Safety funds are low-risk, low-interest funds made up of safe bonds. U.S. government income funds invest in U.S. government securities like bonds. Some other types are money market, international money market, Ginnie Mae funds, invest in mortgage securities, global bond, and zero-coupon bond. High-yield bond funds invest largely in so-called junk bonds. Next are income funds, growth and income funds, and balanced funds, all of which invest in a mixture of stocks and bonds to lower risk and cushion the loss during hard times. Stock funds, also called equity funds, generally involve more risk than money market or bond funds, but they also can offer the highest returns. A stock fund's value, NAV, can rise and fall quickly over the short term, but historically stocks have performed better over the long term than other types of investments. Not all stock funds are the same. For example, growth funds focus on stocks that may not pay a regular dividend but have the potential for large capital gains. Others specialize in a particular industry segment such as technology stocks, medical, or leisure stocks. The following are categories of stock funds. Aggressive growth funds are made of stocks of companies that have a high growth potential, usually developing companies in high-risk industries, hence there's a risk involved. Growth funds are more stable, preferring to invest in larger and blue-chip companies. Asset allocation funds invest in everything: stocks, bonds, foreign ADRs, etc. They can either be a fixed portfolio focusing on certain sectors of the market or flexible, changing with what's hot in the market. Lifestyle funds are similar but geared to people of different demographics. Convertible funds invest in stocks and bonds that convert to stocks. Emerging company growth funds are funds that deal with new, upstart companies. Equity income funds invest in large blue-chip companies and utilities. They're stable but the potential for growth is low. Fund funds invest in mutual funds. Global equity funds invest in American and foreign stocks. International equity funds invest in foreign stocks. Gold and precious metal funds deal with mining companies and exploration. They are risky at best. Growth and income funds are basically the same as equity income but a little riskier and more growth-oriented. Industry funds focus on one specific industry like energy, biotechnology, aviation, utilities, etc. International funds invest in foreign stocks and bonds and could be risky since foreign markets are not as tightly regulated as ours. Real estate mutual funds. If interest rates rise, they're bad; if they go down, they're good investments. Sector/specialty funds/select focus on specific individual stock areas like health, utilities, energy, and finances. Small cap funds invest in mid-size companies. Microcaps invest in small companies. Social conscience funds are funds that contain stocks of ecology-oriented companies. They generally have a poor track record. Value funds invest in stocks that are currently going through hard times and hope they will recover. Usually an investment company has a variety of funds to choose from in different categories ranging from high risk/high yield to low risk/low yield. Bear funds/balanced funds/market neutral funds/long short funds. Bear funds/balanced funds/market neutral funds/long short funds all invest in a mixture of stocks and bonds to lower risk and cushion the loss during hard times. Market neutral hedge funds try to give zero market risk by balancing long and short investments. fundsavvy.com/mutual_funds_articles/bear-market-mutual-funds.htm 7twelvebalanceedfund.com advancecapitalonline.com/content/balanced-fund. Charitable funds. You can save on capital gains taxes by donating some of the value of these funds. CharitableGiftTrust.org 800-664-6901 CharitableGift.org 800-952-4438 ProgramForGiving.com 800-690-0438 SchwabCharitable.org 800-746-6216 VanguardCharitable.org 888-383-4483 Exchange-traded funds/ETFs. Barring index mutual funds. An investment instrument is exchange-traded funds/ETFs. They are a form of unit investment trust/IT, which means a pool of stocks which people buy shares in. An ETF is a pool of stocks that are put together to create a new stock, just like any stock on the stock exchanges which the investor buys and treats as a stock, but in reality, the nature of it is a mutual fund. ETFs are often chosen to mirror the stock indexes just like index mutual funds do. They're mostly found on the American Stock Exchange. They have less fees than mutual funds. They are a minor variation of index funds, also called index participation units/EPUs. Think of index-based funds that trade like a single stock. Unit investment trusts do this too. An ETF is a group of stocks that reflect the composition of an index just like an index fund, but whereas an index fund gets its value from the NAV, net asset value. An ETF is bought and sold like a stock, so its value depends on its share price. Expect to pay management fees. Barclays Global Investors, Barclays, calls their ETFs iShares. iShares.com, iShares ETFs. Plus500.com, ETFs on indexes. HorizonsETFs.com. BestTrendTrading.com/ETF-investing-2. ExchangeTradedFunds.com. Spiders/SPDRs. Spiders are exchange-traded funds/ETFs based on an index like a mutual fund based on the S&P 500 treated and traded as an ETF, which is a stock. Fool.com/mutual funds/index funds/index funds 04.htm, investing in spiders, SPDRs. SavvyWomenInvesting.com/459, how to make money with spider stocks and other ETFs. SPDRindex.com. Foreign mutual funds. Most fund families have international or global funds where they invest in foreign countries. Just look for words like foreign, global, international, world, Asia, European, Latin American, Russian, etc. in the name of the funds. There are closed-end foreign funds which trade as stocks. websontheweb.com. 800-810 Webs. Boston EquiServe offers several. Brazilian Equity/NYSE BZL. 800-969-3306. Emerging Markets Infrastructure/NYSE, EMG. 800-969-3365. Emerging Markets Telecommunications/NYSE, ETF. 800-969-3364. First Israel/NYSE, ISIL. 800-969-3321. Indonesia/NYSE, IF. 800-969-3294. Funds made up of funds/faux funds. Faux funds are mutual funds created by investing in a bunch of different mutual funds as opposed to mutual funds which are usually made up of stocks. They can't be very popular because I could barely find any knowledge about them. fma.org/stockholm/papers/minimizing-hedge-fund-biases.pdf. fofunds.com. Chapter 3. Types of mutual funds 2. Hedge funds info. Hedge funds get a bad rap in good times because they are conservative, but are good in bad times because a wise hedge fund manager knows how to short sell to make money while the stocks are dropping. What you are doing is trying to pick a combination of stocks and then use the following techniques to maximize your return. 1. Short selling. Borrow a stock and sell it at the current price, hoping the price goes down so that you can then buy it back at a lower price and return it, pocketing the difference between what you sold it for and what you paid for it when you bought it back. 2. Leveraging. Borrowing money from your brokerage or someone else in order to increase your profit if you think there's a deal coming around. 3. Also buying and selling stocks, normally sometimes called long selling, where you hope the price rises after you buy it. Hedge fund investing is maximizing your position such that you are covered no matter what happens. You will make money or at least not lose much, because when you make a move in one direction, you also make a counter move to cover it in case the move ends up in a loss. What you're looking for is to buy a mix of stocks that you think are both 1. Undervalued, so you think the price will rise. 2. Overvalued, they're priced too high, so you'll short sell them to make money when they lose value. This is what hedge fund managers do. They use short selling when they think a stock price will drop and leverage whatever money they have, which is to borrow more in the hopes of increasing their profit when they sense a good deal. Hedge funds don't follow the conventional swings of the market because the fund manager is not thinking that way. He's looking for ways around it with sometimes gutsy, risky moves. That's your risk, trusting the fund manager when he takes his risks. Buy hedge funds from the mutual fund companies. They could be called hedge funds, long/short funds, global funds, or even something like an alternative strategy fund. Try number 332.645 or HG 5154.5 at the library. e-hedge.com, hedgefund.net, hedgeworld.com, thehfa.org. Index funds/index fund stocks. An index fund is a fund that takes stocks from a particular index like the Dow Jones Industrials, the S&P, Russells, etc. Refer to the section on exchange-traded funds/ETFs. Index funds try to mirror the performance of stock market indexes like any of the 4 Dow Jones indexes or the Standard & Poor's 500 Composite Stock Price Index, which is made up of 500 blue-chip stocks and is widely considered to be the benchmark against which stock mutual fund portfolio managers compare themselves, while the Dow Industrials tracks the movement of only 30 of the largest blue-chip stocks traded on the New York Stock Exchange. Index funds mirror the performance of the stock exchange in general and are somewhat stable since the fund managers leave very little to their own whimsical judgments and let the market determine where they will invest. The fund managers usually invest more money in the bigger companies within the particular index the fund mirrors. I have scanned a lot of books, websites, and magazines about money, and one consistency I found among both so-called experts and some woman who writes some little money advice book supposedly geared for women is that a lot of people really like index mutual funds that simply mirror one of the stock indexes out there. The fund managers simply pick the stocks in that index, and over time, they're a no-brainer way to achieve good investment gains. One guy says buy an S&P 500 index fund, add money to it every month and you won't have to think about it. It will make steady gains year by year. The deal is that index funds routinely do better than other funds managed by fund managers who actively pick funds based on their research and supposedly educated guesses. Nobody knows exactly why this happens, but the bottom line is that very few fund managers beat the indexes, and of those that do, they only beat them by a little, and those that don't often underperform by a lot, so index funds are a no-brainer way to invest. It's very difficult to outperform the indexes, and very few fund managers ever do, even though that's the purpose of their lives. You get a good mix of stocks for diversity without trying to gamble, at which ones will win. You don't have to bother with the hassles of picking stocks and hoping for the best, simply buy index funds, and because of the diversity inherent in their structure, you will make steady gains. It's a cheap, simple way to invest. The fees for index funds are generally lower than for other actively managed funds because there's almost no thought involved in picking stocks out of a particular index. Capital gains taxes are largely deferred in index funds. You don't have to pay for financial advice, waste time doing research, nor pay out money every time you make a stock trade hoping for the big score. All the big companies have them. Look for mutual funds with the words index in them, like Stock Market Index Fund, International Index Fund, Foreign Companies, 500 Index Fund, which mirrors one of the common indexes like the Vanguard 500, the Nasdaq 100, the Dow Jones Industrials, or Small Cap Index Fund, which is made up of companies worth under $100 million or so. A minor variation of index funds are exchange-traded funds/ETFs, or index participation units/epubs, which are index-based funds that trade like a single stock. Unit investment trusts do this too. It is a group of stocks that reflect the composition of an index just like an index fund, but whereas an index fund gets its value from the NAV, net asset value. An ETF is bought and sold like a stock, so its value depends on its share price. Morningstar.com lists ETFs. iUnits.com sells them. Consider diversifying into global, international, and global index funds too. Refer back to the stock indexes section for the names of some indexes. Books about index funds are at number 332.6327 or HG 4530 at the library. Indexfunds.com, indexfundsonline.com, iShares.com, Vanguard.com, biggest seller of index funds. Commodity Index Mutual Funds. United States Commodity Index Fund.com. money.zine.com/investing/mutual-funds/commodity-mutual-funds. Segregated Funds Info. A segregated mutual fund is a fund with a guarantee that you'll get a certain percentage of your investment back no matter what happens in the stock market. A segregated fund is a form of individual variable annuity sold by life insurers and by mutual fund companies that partner with insure companies to provide the contract guarantees. It's a mutual fund with insurance. People buy them for the security. You benefit from stock market returns with little risk of losing money. When you buy a segregated fund, you pick from a limited list of investment funds the company provides. Your seg fund can go up and down depending on the market, so the value can go down. Seg funds are unique because of two guarantees. 1. The maturity guarantee. On maturity, usually after 10 years or more, you can cash in your investment. Even if the market is way down, the insurer will pay back at least 75% of your original investment and sometimes 100%. If your account value has grown, it's all yours. 2. The death benefit guarantee. If you die, your beneficiary receives either the original principal investment or the market value, whichever is highest immediately without having to go through probate. In Quebec, the beneficiary must be your spouse, parent, child, or grandchild. Seg funds typically mature at least 10 years after the purchase or at 90 years old. Management expenses, taken out regularly, cover the cost of the guarantees along with a profit for the mutual fund company. Because they're classified as insurance products by law, creditors can't seize seg funds as long as you designate a beneficiary. Seg funds cost more in fees than other mutual funds, but people buy them for the guarantees. Some of the various fees that segregated funds could charge are: initial sales charge. You pay a sales commission similar to the sales charges for mutual funds. Surrender charge. If you cash out within the first several years, the company keeps a certain percentage of the initial premium as a surrender charge, around 7% or less depending on how many years you had the fund for. Management expense ratios / MERS. These fees can be as high as 4% per year. Other fees like trailer commissions and switching fees. Here are some other possible features of some seg funds. With some seg funds you can choose to reset the maturity and death benefit guarantees, usually up to 90 years. You get to lock in the profits when the market value of your seg fund is higher than the original investment amount, so when the fund matures or you die, the value is at this higher amount. Guaranteed minimum withdrawal benefit GMWBs. After you're retired, you can withdraw money from a seg fund in the form of a traditional life annuity, or you can withdraw cash monthly and leave the rest in a fund, playing the stock market. What it comes down to is that you're paying an annual fee to get some security in case the mutual fund tanks. If you buy a seg fund, be ready to have that money locked in for at least 10 years. To find a good seg fund company, read the insurance company ratings at amist.com, moodis.com, or standardpoor.com. en.wikipedia.org/wiki/segregated_fund. farafinancials.com/segregated-fund-vs-mutual-fund. huistrusteco.com/faq_segregated_funds.html. huistrusteco.com/segregated_funds.html. Target date funds/life cycle funds/age-based funds. Life cycle funds, also known as target date funds, are built as hassle-free ways to invest for retirement, but as with all mutual funds, the principal value of the life cycle funds is not guaranteed. Target date funds/life cycle funds are mutual funds in which the assets change based on your age. The fund manager invests in other mutual funds including exchange-traded funds/ETFs, so a target date fund is a mutual fund made up of mutual funds. You invest in a target date fund and give a date as to when you want to withdraw the money. Target date funds are generally offered by large mutual fund families and banks that manage the underlying funds that the fund managers pick. They usually have a year date in the fund's name, like Fidelity Target 2035 Fund. Managers mix the funds in the target fund over time, so the asset allocation reflects how close you are to retirement in terms of risk. The closer to retirement, the more conservative and less risky they are in picking funds, but it's all subjective anyway. The target date could be anywhere from 5 years to 30 years or more. Target risk funds usually come in 3 varieties: aggressive, moderate, conservative. You pick your risk tolerance. You let the fund manager use his intelligence to pick what he perceives as the best mutual funds and stock categories, thereby saving you both the hassle and trading fees if you were to buy and sell stocks and funds. Target date funds diversify your investment over many different funds. Target date funds are inexact at best. Fund managers claim to pick funds that will best serve you when you retire in 20 years or so. That's a joke. Nobody knows what will happen next year, much less in 20 years. Fees can be high for target date funds. You pay the management fees, then they might want an additional fee for the portfolio manager. Most target date portfolios invest only in the funds their company owns, so you're only getting access to a limited number of funds next to all the funds out there. Overall, a target date fund is an easy way to invest some money and let the fund manager try to figure out the best investments at any particular time. mutual-funds-advisor.com/401k-retirement-life-cycle-mutual-funds.html mymoney-blog.com/what's-inside-your-target-or-life-cycle-retirement-fund.html t-headegare-ti-life.com/blog/target-date-funds-life-cycle-funds. Mutual funds for kids. Invesco, diving into your financial future. 800-525-8085. Invesco.com. Steinrow Young Investor. 800-338-2550. Steinrow.com. USAA First Start Growth. 800-235-8377. USAA.com. Principal Protected Equity Participation Notes. Some companies sell investment instruments that are a combination of a bond and a mutual fund. In exchange for a fee, the company guarantees that you will never lose the principal balance. This guarantee is only as good as the company is solvent. Ing calls theirs personal protection funds.